Okay, dear students, let's start the second live revision class of SBR. The session is March 2025. And again, it's just a second class, so it will not be so long. But after that, from class number 3 onwards, number 1, live revision classes, they are going to be very interesting. Plus, the duration of the class will definitely increase. So first 2 classes, just you can say like in workout we do warm up, so take it as warm up. So but after warm up, proper workout will start. Okay, now let's start. IAS 38 intangible asset. Basically, in a IAS 38 intangible asset, number 1, we need to have a really good understanding of the meaning of intangible asset. Second, what is the accounting of intangible asset? Third, there are 2 types of intangible assets. One is internally generated intangible asset, and the second is purchase intangible asset. So let's start. An intangible asset is an identifiable. That's very important. Even though we know that when we say intangible asset, we say without physical substance. Even it is without physical substance, but it must be identifiable. For example, if you have a license to start the franchise, let's say you have a license of, assuming Gloria Jeans. So that license is itself is an intangible asset, but obviously that is identifiable. Then it says non-monetary, identifiable non-monetary assets. There are 2 types of assets. One is monetary and another is non-monetary. Actually, monetary asset means where fixed cash is determinable. Examples of monetary asset, for example, cash. Another example of monetary asset is accounts receivable. But here we are saying non-monetary asset. Non-monetary asset means where fixed cash is not determinable. Basically, when we say accounts receivable, we exactly know that how much we are going to receive. That is monetary asset. But in case of intangible asset, obviously we cannot say that, how much we are going to receive. So an intangible asset, identifiable and non-monetary. Non-monetary means where fixed cash is not determinable. Without physical substance. An intangible asset is initially recognized at cost. Do not forget this. Intangible asset initially recognized at cost if it is identifiable. Number 1, it must be identifiable. For example, your company has acquired the license for exporting. So exporting XYZ goods. So that license is identifiable. It is controlled by an entity. If you have acquired the license for export, so obviously it is controlled by you. It will generate probable future economic benefits for the entity. Probable means more than 50% plus. So there are more than 50% chances. Just a minute, one student is having problem in login. Let me pause this. The point number 3 says it will generate probable future economic benefit, means there are more than 50% chances. There's more than 50% chances that organization will get the economic benefits. Fourth, the cost can be measured reliably. Okay, now. If an intangible asset does not meet the recognition criteria, then it should be charged to the statement of profit and loss as expenditure incurred. Obviously, if it is not meeting the recognition criteria, then you have to expense out. Intangible assets should be amortized over their useful life. Now listen. Intangible asset. If intangible asset is having a specific life, definite life, then we are, for example, definite life could be 4 years, 3 years, 6 years. Let's say the useful life is 5 years. If useful life is 5 years, then I'm going to amortize intangible asset over 5 years. Then I'm going to amortize intangible asset over 5 years. But if my company says the intangible asset is having an indefinite life, if useful life is indefinite, if the useful life is indefinite means we cannot right now estimate what will be the useful life. It is so long. For example, if today we need to decide that how long we will see the brand Levi's, so obviously we'll say that right now it is not countable. Right now we can say that Levi's will be there for many, many years. So according to IAS 38, when intangible asset is having indefinite life, then we cannot amortize it. But in case of indefinite life, every year, you have to perform impairment test. Either there is indicator of impairment loss or not. So repeat, if intangible asset is having definite life, specific useful life, then over the useful life, it will be amortized. And we know that amortization method should match with the pattern of economic benefit from intangible asset. But if an intangible asset is having an indefinite life, means we cannot determine the useful life, it is so long, then we cannot amortize it. But if an intangible asset is having indefinite life, then according to IAS 36, every year you have to perform impairment test, impairment review. Either there is indicator of impairment loss or not. Intangible assets should be amortized over their useful lives. If it cannot be demonstrated that useful life is indefinite, then no amortization should be charged, but annual impairment review must be carried out. Intangible asset can be revalued, but only if fair values can be determined with reference to the active market. According to IAS 38, for intangible asset, there are two possible models. One is cost model, another is revaluation model. But revaluation model is only possible. Revaluation model is only possible if your intangible asset is having an active market. Revaluation model is only possible when your intangible asset is having an active market. Active market means obviously where there will be number of sellers and buyers and the products will be similar. Now listen carefully. According to IAS 38, most of the intangible asset, they do not have their active markets. So according to IAS 38, most of the intangible asset, they do not have their active market. So that is why more suitable model is the cost model. Because revaluation model is only available when there is an active market of your intangible asset, and normally intangible assets, they do not have active market. So it means most of the time we can say that suitable model for intangible asset is cost model. Intangible asset can be revalued, but only if fair values can be determined with reference to active market. Costs incurred during research must be expense as they are incurred. So basically, in case of internally generated intangible asset, we know that there's a specific example for internally generated intangible asset, that is R&D, research and development expenditure. So for your internally generated intangible asset, when your intangible asset is in the research phase, then according to IAS 38, expenses incurred will be expense out under research phase. But after the research phase, when development phase starts, then there are certain conditions. Basically, you can say there are 6 conditions. If all the conditions are met, only then development expenditure will be capitalized. Otherwise, development expenditure will also be expense out. So in case of development phase means working on the findings of research. So in case of development phase, there are 6 conditions. If all of them are met, then development phase expenditure will be capitalized. Costs incurred during the research must be expensed as they are incurred. Costs incurred during the development should be recognized as an asset if they meet the following criteria. If they meet 6 conditions. Number 1, the project is technically feasible. Simply you can say that completion of the project is technically feasible. B, the asset will be completed and then either you are going to use it or you are going to sell it. So you are going to complete the asset and either you will be using the asset or selling it. The entity is able to use or sell the asset. So you have the ability. Actually, only intention will not work. You need to have the ability as well. The entity is able to use or sell the asset. Means it is, when we say the entity is able to use or sell the asset, it means that they have the ability to use it or to sell it. The asset will generate future economic benefits. When we say future economic benefit means if you are going to utilize the asset, obviously you will be getting the future economic benefits, or by selling you will be getting the future economic benefits. The entity has adequate technical, financial, other resources to complete the project. So technical resources are fully there. Financially, they don't have any problem at all. The expenditure on the project can be reliably measured. So expenditure on the project we can measure reliably. If all the conditions are met from A till F, only then development phase expenditure will be capitalized. Capitalized means obviously it will become asset. Amortization over the useful life of the new product or process will commence once the project is completed. Once your intangible asset is completed, then you will start amortization. So basically, according to IAS 38, intangible asset, number 1 is you need to know this recognition criteria. An entity asset is initially recognized at cost if that intangible asset must be identifiable, controlled by the entity, and will generate future economic benefits for the entity. Cost can be measured reliably. Another thing is intangible assets. Obviously, initially we need to keep that asset at cost. Subsequently, you can say there are 2 models. One is cost model, another is revaluation model. Revaluation model is only available when there is an active market of your intangible asset. Only then you can go for revaluation model. And normally, according to IAS 38, intangible asset, which organizations they have, normally their intangible assets do not have an active market. So that is why. Most of the time, the suitable model is the cost model. Another point is that is regarding the useful life of your intangible asset. If asset is having a specific useful life, 3, 4, 5, 6 years, 10 years, then it will be amortized over its useful life. But if the life is indefinite, we cannot estimate the life that is so big, let's say, then according to IAS 36, you have to perform impairment review every year, irrespective there is an indicator of impairment loss or not. Okay, now come here. Under research phase, the cost incurred in research phase will be expense out, but in case of development phase, there are 6 conditions. All of them must be met. If all of them are met, then development phase expenditure will be capitalized. And the conditions are the completion of the project is technically feasible. Asset will be completed and then used or sold. Entity is able to use or sell the asset. The asset will generate future economic benefit. Entity has adequate, sufficient technical, financial, other resources, and expenditure can be measured reliably. Now shown IAS 36 impairment of assets. The objective of IAS 36, the objective of IAS 36 is carrying amount of the asset should not exceed recoverable amount. Repeat. The objective of IAS 36 is carrying amount of the asset should not exceed recoverable amount. If let's say the carrying amount is 20 million and assuming recoverable amount is 18, so then you should be prepared to recognize impairment loss of 2 million. So according to IAS 36, carrying amount means the amount which is written in SOFP. Carrying amount of the asset should not exceed recoverable amount. If it exceeds recoverable amount is higher of fair value minus cost to sell and value in use. So simply according to IAS 36, the objective is carrying amount should not exceed recoverable amount. An impairment loss is the amount by which the carrying amount of an asset or cash generating unit exceeds its recoverable amount. So if the carrying amount is 20 and the recoverable amount is 18, then there is an impairment loss of 2 million. Impairment is measured by comparing the carrying amount of an asset with its recoverable amount. Recoverable amount is higher of fair value minus cost to sell, selling price less direct selling cost. Value in use means present value of future cash flows from continuing use of the asset. So basically, according to IAS 36, all those assets which fall in the scope of obviously IAS 36, make sure their recoverable amount should not, their carrying amount should not exceed the recoverable amount. If their carrying amount is exceeding the recoverable amount, it means the difference is impairment loss. I said make sure carrying amount of the asset which fall in the scope of IAS 36 should not exceed, their carrying amount should not exceed the recoverable amount. Now the question is, what is the list of the asset they fall in the scope of IAS 36? So it's very simple. Let me tell you. Scope. So basically, there are two ways to memorize the scope. One is try to memorize the list on which IAS 36 is applicable. But I always feel you should try to memorize the list on which IAS 36 is not applicable. Obviously, if I know the list on which IAS 36 is not applicable, it means then all other assets IAS 36 is applicable. So scope. IAS 36 does not apply on following assets. So list of the assets on which IAS 36 does not apply. Number one is obviously stock. Stock applicable IAS is IAS 2 and IAS 2 says cost of NRV whichever is lower. So 36 is not applicable on a stock. 36 is not applicable on any other current assets. Okay. IAS 36 is not applicable on investment properties carried at fair value model. Now listen carefully. Investment properties, that is IAS 40. In IAS 40 investment property, we have two models. One is cost model, another is fair value model. If investment properties are carried at fair value model, then IAS 36 is not applicable on those investment properties because they are already at fair value. There is another side also. If IAS 36 is not applicable, on investment properties which are carried at fair value model, it means that all those investment properties which are carried at cost model, then IAS 36 is applicable. So investment property which is carried at cost model, then IAS 36 is applicable. We know that logically the investment property should be kept at fair value model because it's an investment. So user will be more interested to know what is the fair value of the investment rather than knowing what is the cost of the investment. But IAS 40 allows both the models, that is cost model and fair value model. So the concept is if investment property is carried at fair value model, then 36 is not applicable. The flip side is if investment property, if it is carried at cost model, then 36 is applicable. Third, asset under IAS 19, that is employee benefits. So there's a possibility that under IAS 19, instead of obligation, you may get asset. If there's an asset under IAS 19 employment benefit, then on that asset, IAS 36 is not applicable. Biological assets carried at fair value. Biological assets which are carried at fair value, again, IAS 36 is not applicable. It means biological asset, obviously, we will see that, inshallah, in IAS 41, agriculture. But if you're keeping biological asset at cost model, which you should not be, but let's say fair value is not reliably measurable, and assuming organization is following the cost model. So the concept is if biological asset is carried at fair value, then 36 is not applicable on those biological assets. But in case of cost model, if you're following cost model for your biological asset, then 36 will apply. Like it happened in investment property. When investment property is carried at fair value, then 36 is not applicable. But when investment property is carried at cost model, then 36 is applicable. Another is IFRS asset under IFRS 5. That is asset held for sale. So asset held for sale, that is IFRS 5. So simply that is non-current asset which are held for sale. Then IFRS 5 is applicable, then IAS 36 is not applicable. So simply you can say the non-current asset available for non-current asset held for sale. IFRS 5. If you have deferred tax asset, again, IAS 36 is not applicable on deferred tax asset. Okay. Now the question is why 36 is not applicable on, let's say, these assets. The reason is IAS 36 is not applicable on these assets because let's say they have their own accounting if the impairment comes. For example, investment property which is carried at fair value. So no need to do any impairment because if the property value increases, we will recognize gain in our income statement. If the property value reduces, we will recognize loss in our financial statements. And when it comes to stock, so stock is already at cost or NRV, whichever is lower. So they don't need any rule of 36 and to look for the impairment. No. Asset under IAS 19, 36 is not applicable. Biological asset which are carried at fair value, 36 is not applicable. Non-current asset held for sale, IFRS 5, 36 is not applicable. And if you have deferred tax asset, that is IAS 12. So obviously you cannot apply IAS 36 on deferred tax asset. So this is the list on which IAS 36 is not applicable. Means other than this list, on all other assets, IAS 36 is applicable. There's one more, that is financial asset, IFRS 9. There's one more, that is asset under an insurance contract. On asset under insurance contract, 36 is not applicable, but asset under insurance contract not in SBR. So the last one itself, it is not a part of your syllabus. Okay, I've just discussed the scope, and this is the list on which IAS 36 is not applicable. Other than that, on all the assets, 36 is applicable. Now, indicator of impairment. For example, if you are having a property, plant and equipment, let's say the carrying amount is 100 million, and assuming the recoverable amount, we know that recoverable amount is higher of fair value minus cost to sell or value in use, whichever is higher, and value in use, whichever is higher. Assuming the carrying amount is 100 million and the recoverable amount is 80 million. So carrying amount is more than the recoverable amount. Whenever the carrying amount is more than the recoverable amount, difference is your impairment loss. So 20 is your impairment loss. Basically, when we are comparing carrying amount with the recoverable amount, it means we are performing impairment review, we are performing impairment test. Logically, impairment review will only be carried out, impairment test will only be performed when there are indicators of impairment loss. Otherwise, normally we do not perform any impairment review. So when there are indicators of impairment, then we will perform impairment test. Impairment review are required where there is an indicator of impairment. Internal indicators. Physical damage of the asset. Obviously, if your organization is having a property, plant and equipment and there's a physical damage, so you should know that. So physical damage is an internal indicator of impairment loss. Management committed to the reorganization of the business. So if there is going to be a reorganization in the business, again, that's an internal indicator of impairment loss. And let me tell you, normally when a company thinks for the reorganization, restructuring of the organization, it means things are not good in the business. Because if everything is okay, everything is fine, why would I go for reorganization? Okay. Idle or obsolete asset. If your asset is not working at the same capacity which it was working earlier. Let's say earlier your asset was working normally at 80% of its capacity. Now most of the time your asset is working just 60%, 50% of the capacity. So that is again an indicator of impairment loss. Another thing is obsolete assets. Let's say the machinery, the technology which you have the way back 10 years back, 15 years back, you have installed. So now that particular machinery, whatever asset they are generating, they are obsolete. Again, it's an indicator of impairment loss. Operating losses in the business where the assets are used. If you are having operating losses in the business, it is also an indicator of impairment loss. Basically, you are running the business, but you are bearing operating losses as well. Again, it's an indicator of impairment loss. Indicator does not mean that impairment has come. Indicator means just perform the impairment test, and then you will automatically get to know either there's any impairment actual or not. External indicators. We do have external indicators as well of impairment. Number one is competitor actions. There's a possibility that assuming you are having a market share of 40% and due to your competitor actions, now the market share is just 10%. That's an indicator of impairment loss. Increase in interest rate. Actually, increase in interest rate, what it does, it reduces value in use. So again, there's a possibility of impairment loss. Why increase in interest rate reduces value in use? Basically, interest rate, it works as a discount factor. When discount factor is higher, then present value will reduce. Market value asset is falling. See, if you bought a new asset and after buying the new asset, you will start using it. So due to usage of the asset, normally the little bit value reduces, but that is okay. But when we are saying market value of the asset falling, so we are not talking about that value which has reduced due to utilization of the asset. You can say that there's a significant decrease in the market value of the assets. Again, it's an indicator of impairment loss. Now listen carefully. Either there's an internal indicator or external indicator. In case of indicator of impairment loss, you have to perform impairment test, impairment review. But these indicators could be reversed, and there's a possibility that in the future, impairment loss could be reversed as well. Let's say in 2023, you have recognized the impairment loss. In 2024, maybe in 2025, things might go in the favor of the business and the impairment loss might be reversed. For example, what are the indicators of reversal of impairment loss? Like, let me tell you, there's a possibility that market interest rate instead of increase, it has decreased. Because if increase in the interest rate is an indicator of impairment loss, then decrease in the interest rate is the indicator of reversal of impairment loss. If market value of asset is falling, that's an indicator of impairment loss. Then market value of the asset, if it starts appreciating, then it becomes the indicator of reversal of impairment loss. Now there's a possibility due to competitor actions. Instead of you getting problem losses, now you're getting benefit. If you just think a little bit in another direction, so indicator of impairment loss, you can easily make them indicator of reversal of impairment loss. For example, let's say when we recognize the impairment loss, the asset was idle, it was just working on 60% of the capacity, and now it is working on its actual capacity, which is 80%. Okay, now, for example, there's a property, plant and equipment. Carrying amount is 100 million. Recoverable amount is 80. We know that recoverable amount is higher of fair value minus cost of sale, and the second is value in use. If carrying amount is more than the recoverable amount, then difference, which is 20, this is impairment loss. Now, please listen carefully. According to IAS 36, when you are going to recognize the impairment loss, then before recognizing the impairment loss, before charging the impairment loss to the income statement, first check, is there any revaluation surplus in the carrying amount of the asset? If yes, then first revaluation will be eliminated. And after that, if any impairment loss is left, that will be charged to the P&L. Repeat. If assets carrying amount is having a revaluation surplus, then first we will have to eliminate the revaluation surplus. The loss which is over and above the revaluation surplus, that will go to income statement. For example, here we need to recognize impairment loss of 20 million, and assuming examiner says there's a revaluation surplus of 5 million, which is included in this 100. Now look at this. Revaluation surplus slash OCI debit by 5. Your impairment loss, which is charged to P&L, that is 15. And your property, plant and equipment is credited by 20. So first you have to eliminate the revaluation surplus. If the loss is even more than that, then the loss which is over and above the revaluation surplus, that will go to income statement. Now come here. Cash generating unit, CGU. Normally a single asset cannot generate cash inflows. Normally a single asset cannot generate cash inflows. It is always the group of assets which generate cash inflows. So a cash generating unit is the smallest group of assets that generates independent cash inflows. Simply, cash generating unit is the smallest identifiable group of assets which cash inflows are largely independent from other cash generating unit. Repeat, cash generating unit is the smallest identifiable group of assets which cash inflows are largely independent from others. Examples. Actually, let's say you take any, let's talk about Levi's. There are so many franchises of Levi's. So each franchise of Levi's is a separate cash generating unit because inflows of one franchise, they do not depend on others. Each outlet, each franchise of, let's say, McDonald's is a separate cash generating unit. So a cash generating unit is the smallest group of assets that generates independent cash inflows. Look at this. Individual asset may not generate a distinguishable cash flow. In this case, impairment calculation should be based on CGU. Impairment losses on a cash generating unit are allocated to the following order. When we are allocating the impairment loss to a cash generating unit, when we are allocating the impairment loss to a cash generating unit, then please listen carefully. If there is any specifically mentioned asset, then impairment loss first charged to that asset. For example, let's say due to blast, for example, or let's say due to explosion within the organization, particular plant and machinery is destroyed. So if due to explosion, particular plant and machinery is destroyed, then obviously first you have to allocate the impairment loss to that plant and machinery. First you have to allocate the impairment loss to that plant and machinery. After that, it's going to be goodwill. And which goodwill? Obviously, purchase goodwill. Internally generated goodwill cannot be recognized within the books because it is against IAS 38. So internally generated goodwill cannot be recognized within the books. So here, when we are saying goodwill, it means we are talking about purchase goodwill. So let me repeat. What is the sequence of allocating impairment loss to a cash generating unit? Number one, specifically mention asset. The second is goodwill. Third, remaining asset in the proportion to a carrying amount, but only those assets which fall in the scope of IAS 36. For example, if your cash generating unit is having, let's say, stock. So I cannot allocate impairment loss to the stock. If your cash generating unit is having an investment property, assuming which is carried at fair value model, I cannot allocate any impairment loss to that. So when we say number one is specifically mentioned asset, number two is the goodwill, third, all other asset on pro rata basis which fall in the scope of IAS 36. Like I'm talking about property, plant and equipment. No asset can be written down below their higher or fair value less cost to sell and value in use. Obviously, you just need to do one thing. Just compare carrying amount with the recoverable amount and bring your carrying amount at recoverable amount if your recoverable amount is less than the carrying amount. Recognition of impairment losses. Asset held at cost. The amount of the impairment is charged to the statement of P&L. Revalued assets. The impairment is charged to other comprehensive income to reverse any previous surplus on that asset and any excess charged to the P&L. So this one we have just discussed. If if I'm charging the impairment loss, first you need to check if there is any revaluation surplus in the carrying amount of your asset. First, eliminate the revaluation surplus. After that, the loss which is over and above the revaluation surplus, that will go to income statement, that will go to associate. I hope, student, so far everything is clear. Please comment on that. Students, just give me 20 seconds only. Number one, I hope basically in live revision classes, you can see that we are using very concise notes and we are just focusing on the main concepts of each and every IAS and IFRS. So number one, you have to understand all these concepts. Second, you need to, memorize them as well. That is why you can see that these notes are more even smarter than smart notes. Just look at this. IAS 36 starts from here. and it is just ending here. Okay. Now there was one more question. Relaxation. Okay. So in today's class, I think admin has shared the topics. One is 38, we have discussed. The second is 36. The third one was 37. So instead of 37, let me discuss another this one. A very small, very small, I would say, IAS. As I mentioned earlier, it's the second live revision class of SBR. That is why it is not so long. But believe me or not, from class number 3 onwards, the duration of the live revision class will increase, and I can guarantee you the classes will become very interesting as well. And one more announcement, a little announcement. Just only there will be just on coming Saturday, we will not have the live revision class. Only one Saturday. The coming one is off. There's a reason. Because we are visiting to Malaysia for meetup with our ACCA students. So just due to that meetup, only one Saturday is going to be off, which is the coming one. But after that, inshallah, there will be no off. And obviously, the duration of the class will increase. And I guarantee you, the classes are going to be very interesting because when we will start discuss, obviously there will be a lots and lots of discussion on the past papers as well. So definitely the classes will get very interesting. IAS 40 investment property. Investment property is a property held to earn rentals or capital appreciation or both. Can anyone quickly reply? Because I did discuss many times. Can you quickly tell me, anyone, when IAS 16 is applicable on rent and when IAS 40 is applicable? Let's say I've given a property on rent and I'm asking when IAS 16 is applicable and when IAS 40 is applicable. Quickly reply, please. Please, students, you need to write. Students, I'm waiting. What is the answer? Can I say when you have given a property on rent with significant ancillary services, then we apply IAS 16. And when we provide property on rent without significant ancillary services, then we apply IAS 40. If you recall, we did discuss the hotel properties. In hotel properties, obviously, we do not just provide property on rent, we do provide significant ancillary services as well. That is why on hotel properties, IAS 16 is applicable. Okay, when it comes to investment property, one possibility, they are held for rentals. Another, capital appreciation, there's a possibility of both as well. Because your investment property normally, they do not see capital appreciation immediately. It takes time. So there's a possibility that you have given the property on rent right now, and when in the future there will be a capital appreciation, you will sell it. Investment properties initially recognized at cost. An entity can choose either the cost model, that is cost less depreciation, or fair value model. Now stop. It is advisable. It is advisable to keep your investment properties at fair value because it is a investment property. So can I say the investor, user of financial statement, they will be more interested to know what is the fair value of the investment rather than what is the cost of the investment. Is this clear to everyone? Remember, ISB framework says try to provide relevant information. So keeping your investment property at fair value, that is more relevant rather than keeping at cost. Is this clear to everyone? Students, please reply. An entity then can choose. Another thing is, please reply on this. An entity can choose. The term choose refers to what? Whenever the term choose comes, it means what? It is referring, hinting towards what? Students. I'm waiting for the answer. When you have a right to choose, can I say when you have a right to choose, it is going to be your accounting policy. Accounting policy actually gives you the right to choose. The fair value model recognizes investment property in the statement of financial position at fair value. Gain or losses on remeasurement are recognized in the statement of P&L. Investment property which is carried at fair value model, no depreciation. Investment property which is carried at fair value model, no depreciation. And on each reporting date, you have to remeasure the fair value of the investment property, and changes in the fair value, they are recognized through the statement of P&L. So students, that is all about today's class. See you inshallah, all of you and others students as well. I don't know why they are not coming for the live revision class. But from class number 3 onwards, students, the time duration of the class will increase and the classes, they are going to be becoming very interesting, I'm telling you. So thank you very much. Do give the feedback on today's class in your respective WhatsApp groups. Thank you very much and have a nice life. And one public service message. Right now, obviously, in most of the countries, the weather is winter. The public service message for all of you is try to keep your check your water intake, because in winter normally unintentionally we drop our water intake, which is not good for your body. At least 3 liter per day you should be having. At least it should go for 3 to 3.5 liters, and if you are doing workout, then add additional 1 liter, then go for at least 4.5 liter. So keep hydrated. Thank you very much. Let's end the today's class on this public service message. So take care of yourself. Thank you.